Welcome back to Equity Logic. Today, we're diving into the story of a name that's practically legendary in the world of investing, Benjamin Graham. You might know him as the father of value investing, the mentor of Warren Buffett, and the author of Security Analysis and The Intelligent Investor. But here's something wild. In 1929, his investment course at Columbia University was so popular that they had to post guards at the door to keep the crowd under control. Students would literally run out of the classroom mid-lecture to call their brokers and buy whatever stock he had just analyzed. That's the kind of rock star status we're talking about. But Graham's story isn't just about brilliance and fame. It's also about devastating losses, painful lessons, and a kind of humility that only the market can teach you. So stick with us. Because his journey from Wall Street star to a broke, humbled investor, and then to the godfather of modern investing, is nothing short of extraordinary. Okay, in 1929, Benjamin Graham's investment course at Columbia University was so popular that they had to post guards at the door to keep the crowd under control. Can you imagine a finance class causing that kind of frenzy today?
That's incredible. It really shows how much people were caught up in the stock market mania back then. But it also says a lot about Graham himself. He wasn't just a teacher, he was a Wall Street star. Where do you want to start with this?
Let's start with the context. The market was in this massive bull run, and everyone wanted to learn how to get rich. Graham was already a successful investor, so his course wasn't just theoretical. It was practical, actionable, and, honestly, magnetic. People were desperate to hear what he had to say.
And what's fascinating is how he used real stocks as examples in his lectures. He'd analyze whether they were overvalued or undervalued, and some of those stocks actually went up in price after he mentioned them. It's like he was moving the market just by teaching.
Exactly. It got to the point where students would literally run out of the classroom mid-lecture to call their brokers and buy whatever stock he had just analyzed. That's how much influence he had. And then, of course, the class became so popular that they had to bring in guards to manage the crowd. It's almost hard to believe.
It really is. And then you have people like David Dodd, who became his assistant professor, and Irving Kahn, who recorded and sold Graham's class notes. Kahn even went on to become a legendary investor in his own right, managing money well into his hundreds. It's like Graham's classroom was this incubator for future investing giants.
Right. But even with all his brilliance, Graham wasn't immune to the pitfalls of the market. By the time the crash hit, he was managing $2.5 million, and over the next few years, he lost nearly 70% of it. That's a staggering loss, especially for someone as methodical as Graham.
And what's so striking is that he had opportunities to avoid some of those losses. Bernard Baruch, the Wall Street titan who famously sold all his stocks before the crash, actually warned Graham. Baruch even offered him a chance to join his team, but Graham turned him down.
That decision is so fascinating to me. Baruch wasn't just some guy. He was a legend, advising presidents and making market calls that were almost prophetic. But Graham, for all his intelligence, was overconfident. He believed his stocks were undervalued and safe, even as the market was clearly overheating.
And isn't that such a human thing? To think that your analysis, your strategy, will somehow shield you from the chaos? Graham's story is a humbling reminder that the market doesn't care about your logic, especially when leverage is involved.
Oh, leverage was definitely his Achilles heel. Even though he reduced it to 125%, it wasn't enough. The market just kept having and having again. By the time the Dow hit its lowest point in 1932, Graham had been through the ringer.
But out of that pain came some of his most enduring lessons. His reflections on leverage and speculation, which he later wrote about in The Intelligent Investor, are still relevant today. He learned the hard way that borrowing money to invest is a gamble, no matter how undervalued you think your stocks are.
And what's interesting is how his most famous student, Warren Buffett, found a way to use leverage without falling into the same trap. Buffett's use of insurance float as a form of non-reflexive leverage is brilliant, but it's also a testament to how much he learned from Graham's mistakes.
Absolutely. And speaking of mistakes, Graham's decision to ignore the advice of that 93-year-old business veteran in Florida is such a poignant moment. The old man told him to sell everything, pay off his debts, and return the capital to his investors. But Graham dismissed him as senile. It's almost Shakespearean in its irony.
It really is. And it's a reminder that wisdom can come from unexpected places, but you have to be willing to hear it. Graham wasn't, at least not then. But to his credit, he did eventually reflect deeply on his mistakes and use them to shape his future approach to investing.
And that's what makes him such an enduring figure. He didn't just teach people how to analyze stocks, he taught them how to think about risk, human behavior, and the importance of humility in the face of the market. Those lessons are just as relevant now as they were in the 1930s.
They really are. And I think that's why his story resonates so much. It's not just about the numbers, it's about the human side of investing. The greed, the fear, the overconfidence, the regret, it's all there. And it's also relatable.
It is. And it's a story that keeps repeating itself, in one form or another, every time there's a market bubble or crash. The players change, but the script stays the same. And that's why Graham's lessons are still so valuable.
Absolutely. So, what's your biggest takeaway from all this?
For me, it's the importance of humility and risk management. No matter how smart you are or how sound your analysis is, the market can and will humble you if you're not careful. What about you?
I think it's the reminder to listen to wisdom, even when it comes from unexpected places. That old man in Florida saw what Graham couldn't, but Graham wasn't ready to hear it. It's a lesson in keeping an open mind, especially when the stakes are high.
Well said. And with that, I think we've covered a lot of ground. Graham's story is a treasure trove of lessons, and I hope it inspires people to think more deeply about how they approach investing and life.
Me too. And so that was part one, where we saw Graham at the height of his fame, but also at the depths of his losses. He ignored a wise old man's warning, got crushed by leverage, and lost nearly 70% of his clients' money. But here's the thing. Out of that pain came some of his most powerful insights. And it was during the darkest days of the Great Depression that Graham truly found his genius. Think about this. Back then, there were companies whose stock prices were so low, you could buy the entire company, liquidate it, and still walk away with a profit. That's the kind of market Graham was navigating. And he didn't just keep those secrets to himself. He wrote articles, shared tables of undervalued stocks, and basically shouted from the rooftops, "The market has lost its mind, but you don't have to." So in part two, let's explore how Graham turned disaster into discipline, how he co-wrote the Bible of value investing, and why his lessons about Mr. Market, margin of safety, and the importance of staying rational are just as powerful today as they were a century ago. How about this for a thought? During the Great Depression, there were companies whose stock prices were so low, you could buy the entire company, liquidate it, and still walk away with a profit. That's the kind of market Benjamin Graham was navigating.
That's wild to think about. It's like the financial equivalent of finding a $100 bill on the sidewalk and realizing no one else noticed it. Graham really had a knack for spotting those opportunities, didn't he?
He absolutely did. And what's even more fascinating is how he didn't just keep that knowledge to himself. He was out there writing articles, like his famous series in Forbes in 1932, where he laid out the financials of companies like White Motor Company. He showed that their market cap was only $4.8 million, despite having $36.2 million in net assets. It's like he was saying, "Hey everyone, look at this absurdity."
And he didn't stop there. He even included a table listing 20 companies with market caps below their net cash. That level of transparency is almost unheard of, even today. Do you think people actually acted on his advice back then?
Well, it's hard to say for sure, but the timing is interesting. His articles wrapped up on July 1st, 1932, and just a week later, the Dow hit its lowest point of the century at 41.22 points. After that, the market began its recovery. Whether it was coincidence or not, Graham's message was clear. The market's pessimism was way overblown.
And he didn't just talk the talk, he walked the walk. He started buying up these undervalued companies, even as the market was still in chaos. It's incredible how he managed to stay so rational when everyone else was panicking.
That's what sets him apart. He saw the market as a voting machine in the short term, but a weighing machine in the long term. He wasn't swayed by the emotional swings of the market. Instead, he focused on the intrinsic value of companies, which he believed would eventually be recognized.
And that's where his concept of the margin of safety comes in, right? He wanted to ensure that even in the worst case scenario, the intrinsic value of a company would protect the investor's capital. It's such a simple yet powerful idea.
Exactly. And his famous allegory of Mr. Market really drives that point home. He described the market as this manic depressive partner who offers to buy or sell your stake in a business every day. The key, Graham said, is to take advantage of Mr. Market's irrationality, not be swayed by it.
That's such a timeless lesson. And it's amazing how Graham didn't limit himself to just cigar butt stocks. He also considered factors like earnings and future growth. His valuation formula, which later evolved to include the risk-free rate, is still widely used today.
Although, as Graham himself warned, it's crucial to adjust the formula based on the risk-free rate. He was so cautious about overestimating growth rates. He even suggested using historical growth rates to keep expectations realistic.
That caution served him well. And it's why Security Analysis, the book he co-authored with David Dodd in 1934, became a bestseller and cemented his status as the godfather of Wall Street. It wasn't just the content, it was the timing. The market was hungry for a new approach, and Graham delivered.
What's really interesting is how security analysis marked the beginning of the scientific era of investing. Graham and Dodd broke down the process of securities analysis into something rigorous and repeatable. They treated it like a science, with every step backed by logic and evidence.
And the timing couldn't have been better. The Securities Exchange Act of 1934 had just been passed, cracking down on insider trading and market manipulation. People were desperate for a new, legitimate way to make money in the market, and Graham delivered.
What I love about security analysis is how Graham debunked the popular chart analysis of the time. He called it faulty logic and baseless fantasy. I mean, he just tore it apart. Even decades later, in The Intelligent Investor, he was still warning people against trend-following methods.
And he didn't just criticize, he offered a better way. He emphasized the concept of intrinsic value, which is tied to a company's assets, earnings, dividends, and prospects. He wasn't trying to predict the future. He was focused on understanding the present as accurately as possible.
That's where his idea of the margin of safety comes in. He wanted to ensure that even in the worst-case scenario, the intrinsic value of a company would protect the investor's capital. It's such a simple yet powerful concept.
And then there's the allegory of Mr. Market. It's such a brilliant way to explain the emotional swings of the stock market. Mr. Market is either euphoric or despairing, but the smart investor doesn't let those emotions dictate their decisions. They use Mr. Market's irrationality to their advantage.
It's such a timeless lesson. And what's amazing is that Graham didn't limit himself to just cigar butt stocks. He also considered factors like earnings and future growth. His valuation formula, which later evolved to include the risk-free rate, is still widely used today.
Although, as Graham himself warned, it's crucial to adjust the formula based on the risk-free rate. He was so cautious about overestimating growth rates. He even suggested using historical growth rates to keep expectations realistic.
That caution served him well, and it's why security analysis became a bestseller and cemented his status as the godfather of Wall Street. It wasn't just the content, it was the timing. The market was hungry for a new approach, and Graham delivered in spades.
After that, Graham's life took some interesting turns. He wrote an opera, got involved in economic policy, and even co-founded what would become the CFA Institute. He was juggling so many things, yet his investment firm continued to perform well.
That's the beauty of his system. It was so well designed that it could function with minimal input from him. Walter Schloss's analysis showed that Graham Newman Corporation had an annualized return of 17.6% from 1936 to 1945, compared to the Dow's 10%. That's incredible.
And then, of course, he published The Intelligent Investor in 1949. It reached an even broader audience than security analysis and had an even greater impact. Warren Buffett himself has called it the best book on investing ever written.
It's amazing how Graham's principles have stood the test of time. From the depths of the Great Depression to today, his ideas continue to guide investors. His emphasis on rationality, discipline, and a margin of safety is just as relevant now as it was then.
Absolutely. Graham didn't just teach us how to invest, he taught us how to think. And that's a legacy that will endure for generations.
Yes, Benjamin Graham's story reminds us of something simple but powerful. The market will humble you if you're not careful. But if you learn from your mistakes, like he did, you can turn failure into a timeless philosophy. Margin of safety. Mr. Market. Discipline over emotion. Those lessons are just as vital today. Stay humble, stay rational, and always leave room for the unexpected. Thanks for listening. If you enjoyed this episode, share it with someone who loves a good story about the markets. Until next time.